Welcome to the Good Capital channel. A huge thanks to my teachers across Singapore and professionals for foundational research and knowledge. Please remember, this content is for education and entertainment only, never professional advice. Investing involves risk. Consult with a certified professional before making any investment and trading decisions. Let's keep learning together.
But while you were sleeping, Google's management just greenlit a spend so massive it could literally swallow the GDP of most small countries. We're talking about a $180 billion infrastructure bill for 2026. If you own GOOGL stock, you're currently sitting on a durable, mega-cap AI giant. But here's the part nobody is telling you. The market has priced this thing for perfection. At today's prices, there is zero room for management to trip up. If the AI transition takes a year longer than expected to monetize hugely, or the CapEx continues to burn into future cash flows, the unkillable machine might still be alive, but your position is going to feel a heat. Today, we're going under the hood to see whether the big money is still betting on the Google it Moat, or if they have quietly prepped for a valuation ceiling high. The mathematical footprint of a fortress. Let's look at the engine room. Alphabet isn't just growing, it's accelerating. Total revenue surged from $182.5 billion in 2020 to a staggering $402.8 billion in 2025. That's a 17.2% compound annual growth rate. It's like a lemonade stand that somehow manages to sell a glass to every single person on Earth every single day and still finds new people to sell to. But it's not just search anymore. In Q4 2025, Google Cloud exploded with 48% year-over-year growth. This is the segment that proves Alphabet isn't just an ad company anymore, it's the backbone of the enterprise AI world. It has $126.8 billion in cash sitting on the sidelines. Its interest coverage ratio is an astronomical 903x. Basically, they could lose almost all their income and still pay their debts for a lifetime. For a company this size, that isn't just growth, it's a mathematical footprint of a structural moat. The big money loves its wide moat. 1. The network effect. YouTube alone has 2.7 billion monthly active users. More users equals more data, equals better ads, equals more creators. It's a virtuous cycle that's nearly impossible to break. 2. Intangible assets. Google isn't just a company, it's a verb. That share of mind drives massive organic traffic that competitors have to pay billions to try and replicate. 3. Cost advantage. They build their own chips, the Ironwood TPU v7. While everyone else is begging NVIDIA for GPUs, Alphabet has greater negotiating power and is spreading its costs over a $400 billion revenue base. So why aren't we all just mortgaging the house to buy more shares? Because the management is betting its balance sheet while most retail investors are buying the AI hype.
The big bet, the AI arms race. In early 2026, Alphabet management dropped a bombshell. They are projecting $175 billion to $185 billion in capital expenditures for the year. To put that in perspective, they only spent $91 billion in 2025. They're essentially doubling down on the AI race. This massive infrastructure bill is going to put heavy downward pressure on free cash flow. Management is sacrificing the cash cow status of today to defend against technological obsolescence tomorrow. They have to do this. Gemini 3 is seeing incredible momentum. The Gemini 3 series processes over 10 billion tokens per minute through direct API usage, with usage more than doubling in recent months. But AI-native search costs more to serve than a traditional text link. If they don't spend this money, they risk losing the utility status of Google Search to newcomers.
Our goal at The Good Capital is to give you the same level of institutional research that the guys at Wall Street get, without the $200,000 price tag. Empowered by AI, our analysis is able to delve deeper into the maze of corporate numbers, filter through market noise, and make connections to validate companies' management claims and projections. We only care about the objective data. If we want to build a portfolio that actually compounds, we need to stop following hype and start following unit economics. If you're finding value in this forensic deep dive, hit that subscribe button and join our community of strategic and informed investors. Also, join as a Good Capital member. You gain early access to new videos, members-only video, and institutional-grade full analyst reports for respective companies. These are valuable resources to help you navigate through pitfalls before they take away your hard-earned money.
The bear case, the three-headed monster. Every unkillable company has a backdoor. For Alphabet, it's a three-headed monster that could suppress earnings. Head 1, the regulatory hammer. The European Commission already slapped them with a $3.5 billion fine. But the real threat isn't the money, it's the structural changes. If the DOJ forces Alphabet to unbundle its services or share its ad tech data, the ecosystem moat starts to leak. Remember what happened to Microsoft? Head 2, search disruption. Think of it this way. For 20 years, Google was the librarian. Now, AI models like OpenAI are trying to be the answer. If users stop clicking on links and just read AI summaries, Alphabet's high-margin ad business takes a direct hit. They're fighting back with AI overviews, but the cost to serve those queries is significantly higher. Head 3, the CapEx shock. We already mentioned the $180 billion spend. If revenue acceleration doesn't keep pace with the spending, margins will compress. Wall Street is patient, but if they don't see a clear ROI on these AI data centers by late 2026, they will punish the stock.
The valuation. Is the current share price right? 1. The relative premium. We analyze Alphabet's PE multiple against its daily historical trading range over the last 5 years to identify statistical exuberance or pessimism. Current trailing PE, 28.8x, based on current $312 price, 10.91 EPS. 5-year mean PE, 24.6x. Standard deviation of PE, approximately 2.5x. Z-score assessment. Alphabet is currently trading at 28.8x PE, which is plus 1.7 standard deviations above its 5-year mean of 24.6x. Conclusion. The stock is trading at a premium relative to its historical self, approaching the 2 standard deviation boundary of expensive. 2. The peer multiple. If you're buying a house, you check what the identical house down the street sold for. That is relative valuation. For this metric, we look at how the market is currently pricing Alphabet's direct big tech competitors. The peer multiple. By multiplying the peer group's forward big tech peer multiple of 25.3x by Alphabet's estimated 2026 forward EPS of $12.50, we arrive at the peer adjusted baseline. Relative value equals 25.3x estimated 2026 EPS. This calculation gives us the relative value of $316.25.
The intrinsic value, DCF. Efficiency check, rule of 40. Because Alphabet experiences SaaS-like software margins and high growth, we test its capital efficiency before valuation modeling. Calculation: 2025 revenue growth, 15.13%, plus EBITDA margin, 37.26%, equals 52.39%. Verdict: Alphabet vastly exceeds the rule of 40. This world-class score justifies applying a higher terminal multiple and robust growth assumptions in our valuation. The three-stage discounted cash flow, DCF. Let's look at the math. This is where we separate the hope from the holding. Since Alphabet has greater than 10% revenue growth, we ran a three-stage discounted cash flow model. We will use $132.17 billion net income as a proxy for normalized cash-generating power, bypassing the temporary $180 billion CapEx distortion in 2026. The math breakdown. Stage 1, the high growth. For years 1 through 5, we modeled a 15.0% annual growth rate, which matches their current top-line momentum. Stage 2, the AI maturation.
For years 6 through 10, we assumed growth incrementally fades from 13.0% down to 5.0% as the AI market matures. Stage 3, the terminal phase. For years 11 through 10, we applied a 3.0% perpetual terminal growth rate, roughly tracking global GDP. Weighted average cost of capital, WACC, working it out at 9.60% to reflect the heightened execution risk of the AI transition. Summing up the present value of future net income, add their cash and subtract their debt to find the total equity value. Divide total equity value by 12.10 billion shares to get the intrinsic value equals $351 per share.
Sensitivity stress test. Valuation for growth stocks is highly sensitive to the cost of capital, WACC, and long-term growth expectations. The matrix shows the intrinsic value per share under different economic conditions. The market bull scenario: if interest rates fall and WACC drops to 6.0% with a 3% terminal growth, the intrinsic value jumps to $816. The bear base scenario: at a 11-12% WACC and 2 to 2.5% terminal growth, the intrinsic value sits between $244 to $284. The final verdict. Using DCF value of $351.49, peer PE value of $316.25, and historical mean of $268.39. We triangulate these to arrive at a final fair value of $320.77. Alphabet is currently trading around $310, near the fair value of $320.77. Alphabet is currently trading exactly where it should be. The market has priced in both its world-class core operations, evident by its 52+% Rule of 40 score, and the margin-compressing realities of its $175 billion 2026 AI CapEx cycle. While the historical Z-score warns of a relatively expensive multiple, the three-stage DCF proves the underlying cash generation power supports the price provided management successfully monetizes their AI infrastructure investments. There is no room for execution errors. If you think AI is going to be a money pit before it becomes a money tree, then the unkillable money machine is trading near its current valuation ceiling. Alphabet is a phenomenal business, but there is no deep value margin of safety at these levels. Most people just read the headlines. We check the facts and navigate through the pitfalls and fluffs. If you found value in our sharing, please like, subscribe, and share. All of your support is precious to our small channel. To stay ahead of the market with a level head, hit the bell. We'll see you in the next one.